Hey guys, welcome to the Silver Report Uncut. It seems like all hell is breaking loose all over the world. I wanted to talk briefly about China's housing market. Now first off, there's a national boycott on paying their mortgages. Mostly of course because they're not free, and they're living in hell, and they don't have much money because they've all lost their jobs. But their central television said on their WeChat page that the regulator will guide financial institutions to participate in risk disposals based on the market conditions. This was after the report by researchers, China Real Estate Information Corp, that homebuyers had stopped mortgage payments on at least 100 projects in more than 50 cities as of Wednesday. This is raising concerns that the quality of home loans is rapidly deteriorating, potentially leading to a credit or housing bubble burst similar to the one that occurred in 2007. Now, Bloomberg's Market Live reporter Yi Zai, he said the grassroots movement of the Chinese homebuyers boycotting mortgage payments isn't exactly comparable to the 2008 subprime mortgage crisis in the United States. However, regardless of what Beijing does to address the latest chapter in Chinese housing crisis, banks are likely to bear some of this burden. There was following an increase in the number of homebuyers refusing to pay their mortgages on stalled construction projects. China's banking regulators announced on Thursday that they are coordinating with other agencies to assist local governments in working to ensure the delivery of housing units. Separately, Bloomberg reported that policymakers held emergency meetings with banks to discuss the problem, which is expected to get worse. The boycotts increased the risk of mortgage defaults, posing new challenges for banks already strained by exposure to failing property developers. Mortgage accounts for nearly 20% of the total bank loans outstanding, totaling approximately 39 trillion yuan, or $5.8 trillion. In a rather panicked note, Morgan Stanley economist Xi Kai, he addressed the issue of widespread mortgage non-payment, writing that, quote, "We estimate 188 million square miles are at risk. We expect local governments will be urged to help completion, but there's going to be a national solution that remains difficult in the near term." Adding, "The non-linearity is the key to watch." Others, such as Z, believe that this is an exaggeration. According to the Bloomberg journalist, quote, "It's reasonable to think that this isn't the start of something as bad as the U.S. subprime mortgage crisis. Mortgages, as opposed to lending to developers, has been regarded as the safest assets on bank balance sheets, according to Betty Wang, an economist at ANZ. Mortgage defaults have been uncommon, and rising home prices have increased the value of banks' collateral over time. According to Wang's calculations, the average non-performing mortgage loan ratio of China's 6 largest banks, which accounted for 68% of total home loans in China, was only 0.38% in 2021, compared to the developer MPL ratio of 2.73%. All of this, of course, assumes that the current mortgage boycott movement can be quickly put down. If not, the consequences could be catastrophic. According to Nomura economist Liu Ting and his colleagues, approximately 4.4 trillion yuan in mortgages made between the end of 2020 and March 2022 may be tied to stalled or slow-moving home projects. Chinese banks have, understandably, taken a beating in recent days. The CSI Bank Index, it dropped more than 4% in the last 2 days, reaching the lowest level since March 2020. Their price-to-book ratio has fallen to an all-time low of 0.61%, implying that investors believe a substantial portion of the banking system's assets are impaired. At the same time, the CSI 300 Financials Index fell as much as 1.2% on Friday, marking the 11th consecutive session of declines. Of course, the worse things get, the more likely Beijing will be forced to unleash a powerful releveraging action. Now, Z pointed out, quote, "As mortgage boycotts threaten social stability, the government is likely to intervene sooner rather than later. Banks must either chip in to provide cheap funds for developers to complete their projects, or they must allow the home buyers to postpone their payments. Neither is an appealing option," unquote. Now, what would be the worst-case scenario here? We're going to return to Morgan Stanley's non-linearity kicking in scenario. Homebuyers' confidence deteriorates further from a low starting point, resulting in further declines in property sales. This may force more developers, even if they are relatively strong today, to halt unfinished projects, furthering the downward trend. Meanwhile, housing prices may fall even further, exacerbating the downward spiral. Furthermore, given the extensive intersector linkages, the stress in the housing sector could spread to a broader economy while being amplified by the financial system. In a nutshell, a self-perpetuating downward spiral that culminates in either a historical crash, of the world's largest asset, or a state bailout. And how much more do they have to keep bailing out? According to Morgan Stanley, the following are two most likely policy responses: damage control, where local governments will almost certainly be asked to mobilize resources on a project-by-project basis, possibly with the assistance of SOEs and LGFVs, to restart the stalled projects, signaling to the public that housing completion is a top priority. SOE developers may be encouraged to engage in M&A activities in order to take over some stalled projects, reducing systemic risk beyond the near term. To reduce systemic risks, policymakers will likely need to send a clear and strong signal that they are prepared to be the rescuer of last resort. More meaningful demand stimulation, more explicit guarantees on quality developers, or less likely a TARP-like program are all viable options. In other words, a massive flood of liquidity or fake money and credit is about to be released. And they were already planning to do this for numerous other reasons. I don't know what's going to happen. Now, before we go, I just want to cover the Producer Price Inflation Index, because this is a very, very big story. It's bigger than the CPI, which came in exceptionally hot, and it's not going down either. But in June, the producer price inflation unexpectedly returned to near record levels. This was following yesterday's CPI scare with of course, the fake CPI report. Analysts predicted the producer prices would slow slightly. They were completely and absolutely wrong. The PPI rose 11.3% year-on-year in June. This was returning to a near record high and far exceeding the 10.8% that was expected. This is the 27th month in a row that producer prices have increased month on month. Notably, in contrast to the CPI, the goods PPI is surging while services PPI is slowing. Goods are in high demand. The index on final demand goods increased by 2.4% in June, marking the sixth consecutive increase. Almost 90% of the June increase can be attributed to a 10% increase in the final demand energy prices. The index for final demand goods, excluding food and energy, as well as the final demand foods, increased by 0.5% and 0.1% respectively. Gasoline prices rose 18.5% in June, accounting for more than half of the increase in the index for final demand goods. Diesel fuel, electric power, and residential natural gas, motor vehicles and equipment, and processed young chickens, they all saw increases. In contrast, chicken egg prices fell 30.2%. The indexes for iron and steel scrap and jet fuel both fell. Services were also in high demand. The final demand services index increased 0.4% in June after increasing 0.6% in May. Two-thirds of June's broad-based gain can be attributed to a 0.8% increase in margins for the final demand services. The trade indices track changes in wholesaler and retailer margins, and prices for final demand goods excluding trade, transportation, and warehousing, as well as final demand transportation and warehousing, increased by 0.1% and 0.8%. Food and alcohol-related margins rose 3.8% in June, accounting for more than 30% of the increases in the index for final demand services. Indexes for machinery, equipment, wholesale, outpatient care, passenger transportation, guest room rental, and hospital inpatient care, they all rose. Portfolio management prices, on the other hand, fell 2.7%, and automobile retailing, the long-distance motor carrying indexes also fell. I thank you guys for stopping by and joining us. As always, stay free.